What if you had $50,000 to invest in a dividend-paying ETF like SCHD? Could this single investment outperform your 9-to-5 job and allow you to achieve financial freedom? In this video, we're diving deep into SCHD's past performance, simulating its potential future growth, and breaking down a strategy that could transform your financial future. SCHD is often referred to as a dividend king, a title usually reserved for companies or funds with a proven history of consistent dividend payments. But what truly sets SCHD apart is not just its consistency, but also its growth. Over the years, SCHD has demonstrated the ability to increase its dividends, effectively doubling down on why it's a favorite for many dividend investors. Think about this: a $50,000 investment in SCHD has the potential to grow exponentially. With time, patience, and reinvested dividends, you could realistically create an income stream that outpaces your salary. But before we dive into how that's possible, let's take a closer look at the fundamentals of SCHD. SCHD, or the Schwab US Dividend Equity ETF, is managed by Charles Schwab Asset Management. It tracks the Dow Jones US Dividend 100 Index, which focuses on companies with strong and sustainable dividend-paying histories. At the time of this video, SCHD offers a starting yield of approximately 3.6%, paired with an incredibly low expense ratio of just 0.06%. This means you're keeping more of your investment working for you. Now, what makes SCHD really interesting is the standards they maintain for holdings within this fund. The first criteria is a strong dividend payment history. Companies that have had a minimum of 10 consecutive years of dividend payments are considered. The next section is market capitalization. They only consider stocks with a minimum of 500 million in market cap. Next, they will concentrate one sector at 25% of the fund and no more. There's a few more criteria, but while we're on the topic of holdings, let's take a look at the specific ones that make up this fund. SCHD's holdings are diversified across a number of sectors, with major weightings in financials, healthcare, consumer staples, and industrial. It has a relatively low exposure to technology, setting it apart from many other ETFs. Its top holdings include household names like Pfizer, AbbVie, Coca-Cola, Cisco Systems, and BlackRock. So these are all large household names, and it really gives a sense of history for the types of stocks that SCHD consider for this fund. This diversification strategy makes SCHD not only reliable for dividends, but also some resilience during economic uncertainty, which could be a key factor for long-term investors. As we mentioned before, they're often classed as a dividend king, but they also had a fair run on the share price. Currently trading around $28 per share, the fund has delivered a 40% increase in share price over the last 5 years. If we zoom out further to its inception in 2011, the share price has increased by over 225%. Now, these are already some positive historical results on just the shares. But what happens when you reinvest dividends? This is where the magic of compounding comes into play, and you really get to enjoy the effects of the snowball effect. Over the past 5 years, SCHD's total return, so now including the reinvested dividends, has been approximately 73%. Since 2011, this total return jumps up to nearly 390%. So you can see how the snowball effect becomes quite powerful. Displaying the effects of compounding, it can start off as a short and modest dividend payout. By reinvesting these dividends over time, it can create a rewarding snowball effect. This really demonstrates how reinvesting dividends can significantly amplify your returns, especially over the long term. Let's now focus on SCHD's dividends. We can see how they influence the total return, but let's dissect them a little more. SCHD hasn't missed a single payout in the past decade. For income-focused investors, this kind of consistency is very attractive. But what's even more impressive is the fund's dividend growth rate. Let's take a look using tools like Seeking Alpha, and we can see that SCHD's 3-year dividend growth rate is 9.87%, and over the past 5 and 10 years, this growth rate averages around 11%. This means your dividends could grow faster than inflation, preserving them and even increasing your purchasing power. Let's break this down a little further with our hypothetical example. Here's where things can get exciting. We can finally answer our initial question. Let's simulate what a $50,000 investment in SCHD could look like over 30 years using historical data and growth rates. We'll use a tool called DripCalc to calculate this. Just by typing in SCHD into their search bar, this website will populate some prompts with the historical data similar to what we found. Just walking through these prompts means a starting price of about $28 per share, a dividend yield of about 3.5%, dividend growth rate of 11%, and a share price growth rate of about 7.5%. While past performance doesn't guarantee future results, these numbers can give us a hypothetical outlook. So we will use a 30-year time frame for this example. After 30 years, your $50,000 investment could grow to over $2.7 million, with an annual dividend income of approximately $242,000. For context, the average American salary is around $65,000. This means your SCHD dividends alone could outperform the average salary after 30 years of compounding. Here's another milestone. By year 24, your annual dividend income could surpass this annual average with $77,000 per year. At this point, your dividends might already replace your median household income in the US, providing you with financial independence. These are pretty outstanding results, and while this data is hypothetical, it can provide some optimism for long-term investors who dream of reaching financial freedom. I know that this is one goal for my investing journey, to eventually have dividends replace my income and allow me to become financially free. Now let's just talk about some realistic expectations and risks. It's important to always remember it's essential to stay grounded. Markets are unpredictable, and no ETF is immune to downturns. Factors like interest rates, inflation, and economic cycles can impact SCHD's performance. We really don't know which sectors are going to thrive in the future, and investing is not a smooth ride. It's full of peaks and valleys, which of course is not shown in a tool like DripCalc. We can see from DripCalc that this has a consistent growth year over year, while this may not be the case in reality. SCHD's focus on high quality companies with sustainable dividends makes it a resilient option for long-term investors, and its consistent track record provides some confidence. Could a $50,000 investment in SCHD allow you to quit your job and achieve financial freedom? Based on historical data, it's possible with enough time and power of compounding dividends. If you found this video helpful, please like and subscribe for more investing related content, and let me know what you think in the comments below. Or do you have another favorite ETF? Thanks for watching, and I'll see you in the next one.